Hi, everyone. Thanks for joining tonight's webinar about Taxes 101 for new ABA practice owners. We're joined by second-time host, Ajish here, who will lead our webinar tonight. And I'll let him introduce himself in a couple of minutes here. Maybe as we wait for people to trickle in, would love for folks to introduce themselves, name and state in the chat. I see we already have some people saying hello. Amy from Colorado. Hi, Amy. Tommy from Arkansas. Jocelyn from North Carolina. Courtney, also from Colorado. Love to see the Colorados here. We do a lot of work in the state of Colorado, actually. One of our first practices was in Pueblo, Colorado. So say hello here in the chat, your name and where you're from, as we wait for a couple more folks here just to trickle in. If you're wondering where you are in the right place. We will be talking about how to maximize tax deductions and also tax deduction foundations for how to think about being compliant with the IRS and all that scary stuff that you didn't have to deal with as a W-2, but now you do as your own business owner. Maybe before we get too deep in the weeds, I'll give you a quick introduction about myself and Alpaca. So my name is Michael. I'm one of the founders at Alpaca Health. We are a business in a box for BCBAs to start, run, and grow their own independent ABA practices. We work with folks from the very, very beginning when they just have an idea that they want to start their own practice. And what I ask a lot of BCBAs, and actually this is a quote from one of the BCBAs who worked with us, is, "You've worked so hard for someone else, why not work hard for yourself?" Starting a practice is definitely not easy, and we'll get into some of the reasons from a tax perspective why it's going to get a little bit more complicated tonight. But it's worth it because you have something of your own. And the way Alpaca helps with that is by taking over everything that is non-clinical, so that you can start a practice and still stay focused on delivering high-quality clinical work. What do? We provide you best-in-class modern technology that takes away all of the documentation burden and writes your session notes for them. We totally do your admin for you. We wait on hold with insurance, do verification of benefits, prior authorization, so that you don't have to. And the last piece is we guarantee payouts. So every 2 weeks, we'll pay you, so you'll always have enough in the bank to pay yourself and pay your staff, even if insurance takes longer. We take away all the risk that comes with starting an insurance-funded ABA process. We take away all of the administrative burden, and we give you amazing tools to help you serve your staff and your clients the best as possible. And so that's a little bit about myself. That's a little bit about Alpaca. So I will throw it over to Ajish, our presenter tonight, to introduce himself and to lead tonight's training about Taxes 101 for new ABA business owners. So we'll throw it to you, Ajish.
Thanks, Michael. Glad to be here again and speak with the ABA crowd here. As Michael mentioned, this is my second time partnering with Alpaca and doing these webinars. I am a CPA, been now in the accounting field for close to almost 20 years at this point. And I've been helping a lot of small businesses get off the ground running. And I really enjoy working with like entrepreneurs because they tend to ask like the most detailed questions because they care about the business the most, right? So forums like this where I can pass on some knowledge really is a great way to kind of understand the community and give back. So that being said, I do want to go into today's presentation and say, hey, these are some of the common business deductions that business owners can take. A lot of first-time clients that I have often don't understand that there are deductions available for business and can't differentiate between personal and business expenses. So hopefully going through this presentation tonight will give you guys a little bit more background about, hey, what's actually a business deduction, what I can expense, how to do that in a way that the IRS will come knocking at your door. All right, so let's get started. Um, so first off, right, the most common expense that you could deduct is your professional requirements, right? So as a business owner, right, your core business is conducting your consultation services, right? And even though that's a personal expense that you pay personally to license yourself, it is required. It is necessary for your business, right? So that is something that could easily be expensed, and that is something that should be expensed, um, as well as any memberships or continuing education units that you need to maintain your licensing and certifications, right? All that counts as a business expense, even though that, technically you could stop your business and keep that certification and stuff and go join like a company or do anything like that. For the purpose of your business, it is a business expense. So that is something everyone should be expensing right off the bat. Um, another common deduction that truly is helpful is operational supplies, right? Like anything that you need to support your business, and this includes software like Gmail, if you're paying for a Gmail suite, or if um, project management software, your obviously your uh, uh, utilities and stuff like that to kind of for internet and things like that, and then office supplies, um, pens, paper, computers, and equipment. We'll get into it in a little bit, but pretty much like small items like iPads and stuff like that that you use for your business, you could expense right off the bat. And then of course like therapy tools, materials, flashcards, timers, and all that. All of that is things that you use for the support of your business day to day. It can be expense, right? It is even if some of these items you could also use on the personal side. Let's say you buy an iPad because you need to use that for virtual meetings while you're traveling, right? That is a business item, but you could also use it for personal purposes, like to watch Netflix. But as long as you purchase it uh, from the business, and the majority of the use is business, you can expense that and write off your net income from the business. Any questions there? I want to make sure that that's clear for everyone. Um, so the next item, right? Technology and equipment. Uh, so big items like computers, tablets, and stuff like that. Like obviously small items like iPad, tablets, you can expense right away. Computers, most of the time you can expense right away, but larger items, um, there is a thing called useful life. So we will get to that in a little bit, and that those types of items you need to depreciate over time. And basically, with those, the IRS says, "Hey, you bought a $5,000 MacBook, right? I'm not going to let you take off $5,000 right off your income this year because you're going to use that MacBook for 2, 3, 5 years even. So you should only expense yourself $1,000 a year until that item isn't useful anymore." So that's basically depreciation. And we'll get to that in a little bit more. But for larger items, you would need to depreciate for the most part. There are some exceptions, but that's that caveat there. Mobile phones. So honestly, you can expense the whole thing. The technical rule is that you should deduct the business use percentage, but with these days, like it's so hard to kind of get those percentages. And for a small thing like this, the IRS isn't going to come knocking at your door, right? Um, as long as you use the phone majority for business, you can show that you have business calls and stuff like that through your phone, you should be able to deduct it. Office furniture, like your desk setup, any sort of chairs, equipment, all that can be expensed as well as regular business expenses. The before I move on, I want to also explain like why the business expenses matter so much. Um, the with as a business owner, right? Your net income is derived from your business's net income. So what passes on to your actual tax return is the bottom line of the business. So you may think like, oh, I'm getting X amount of revenue, but that's not what you're paying taxes on. You're paying taxes on the net income. So that's the revenue minus the expenses. So leaving off expenses is really leaving money on the table that you're just giving to the IRS. You want to be absolutely sure that you capture all the expenses that you have needed to generate your revenue, so that what you pay is truly fair in what in terms of that tax that's assessed for you. A lot of folks I know, like they do these like one-offs and say, hey, I don't there's a small expense, I don't need to capture it or record it, or I just paid it with my personal card, I don't need to go back and put it to the business. But it's a compounding effect, because like that, even though it's that small expense that you didn't pay from the business, you also increase the business's income by that much, which also increases your uh, tax liability. So that's why it's truly important. Like you want to capture all your expenses. You want to have good accounting. You want to separate your business and personal expenses so that it's very clear. Um, the next item that I want to talk to you, which is really applicable to most of these practices from what I'm hearing from Michael, is the home office deduction, right? So a lot of times when you are working from home, your workspace is also your home. So how do you manage that from an expense perspective? The IRS basically has a definition. They said that you must meet in order to maintain the home office exclusion. Um, it is you have to have a space that is regularly and exclusively used for business purposes. So, like here an example, right? Like if you meet from your kitchen table, you can't count your kitchen as a home office, right? That's not the primary use of the kitchen. You just happen to work from there. But if you have a room in your house where you um, only have your desk, and you store like your business equipment, business items, and that's primarily used just for working, then it does qualify as a home office. And um, um, this is one of the perks of being a business owner, right? Because this is only something that's claimable by a business owner. So you have to be either 1120 S corp owner, or you have to be uh, uh, a sole proprietor. If you're an employee of a business, this is not something that's eligible for you. The IRS says, hey, that's just part of your employment requirements. You don't get anything. But as an owner of a business, you are able to claim this home office expense. And there's two ways to go about it. Um, there's the simple method, which is called the square footage method. Uh, um, Actually, I take that back. It's not called the square. They're both square footage methods, but there's the simple method where basically um, you figure out the square footage of your space, and then you just get $5 per square foot, and that's a um, flat expense that goes onto your tax return and reduces your income. The other method, which is usually the most better method, you figure out the percentage of your home that that the office applies for. So let's say your office space is 100 square feet and your total home is about 1,000 square feet, right? So then that's 10% of your home. And then all your home expenses, like your rent for the year, your utilities for the year, any repairs that you do, home insurance, renovation insurance, mortgage interest, all of that you sum up, and then you times it by that percentage of 10%. So that usually works out to be a lot better than the $5 per square foot method, right? Like if you had 100 square feet, you get $500, but if you have 10% of your rent, which is well over, 10, $12,000, then that all adds up. So the actual expense method is usually the better method to go for. So the criteria for that is that, again, like your home has to be that portion of your home has to be exclusively used for your business. Um, in terms of record keeping, you definitely want to come up with in the event. Record keeping is always something that I want to preface say that is something that people need to be doing. A lot of times people ask like, well, no one ever asked me for the records, and that's true. Like you don't need to provide the records when you file your taxes. And a lot of accountants and CPAs, including myself, just take your word for it because that responsibility doesn't fall to us. That responsibility falls to you to have the records to back it up if in the event that you get audited. And that's where this really matters, right? Like if you get audited, the IRS is going to ask like, go through every detail of your tax return and say, hey, how did you come up with this? Where did you get 100 square feet from versus 80 square feet? And you got to kind of like explain your methodology and stuff like that. Obviously, like in an audit, like they would give you some leeway and you could explain how you did it, but it's going to be a lot more scrutinable if it's that way versus if you have all the evidence and all that right off the bat. You know, it's kind of they're going to get that impression, hey, this guy knows what he's doing, or this person knows what she's doing, and that we're not gonna dig that much deep into this audit. I got a question from Karen. How would I figure out the percentage of office? Like honestly, the best way that I've done it and advise most of my clients is just like, hey, measure out the room. So like you'll have like a, I don't know, 10 by 10 room. And then I'll go on to like Zillow or Zillow for the most part. And they have a square footage there, which typically is accurate. So I'll just use that as the total square footage. If you're in an apartment, or you should have like part of your lease, it should specify how much total square footage your apartment is. But if you're in your home, like usually the Zillow method seems to work. All right. Any other questions on home office before we move on to mileage? All right. Okay, so then now we talked about direct expenses, business expenses, your home office. Now the next thing I want to talk about is mileage. So if you drive for work, if you go see patients at their facilities, I mean their residences or other places, you're eligible to claim that mileage and travel as an expense, right? Um, the the one thing that does not count is like if you work in an office and you're going to your office every day, that's part of your regular commute and that's not deductible. And then technically, if you do have a commute and days that you don't commute but just go to visit clients, you're supposed to subtract out your typical commute mileage and expenses from the visits. Um, but the mileage expense is pretty straightforward, right? The IRS says, hey, I'm using my personal car. IRS says, hey, you're using your personal car for work. You're traveling to do work items. So we're going to give you a break and we're going to let you expense out the work portion that you're using your car for. So there's two methods to this. There is the standard mileage rate and then the actual expense rate, method rate. So very similar to like the home office deduction where there's the two methods. However, in this case, I always recommend the standard mileage rate. That usually works out to be better unless you exclusively, only use your car for work. Because typically, like, you're going to have more personal or non-work miles in your car than you would work miles, unless you're in that situation, right? You primarily only use your car for work, and so that percentage usually comes out to be very low, and then you have that huge record keeping requirement of collecting, like, hey, how much did you pay for this, how much did you pay for that, how much did you pay for that, versus just keeping a log of your travels and then doing this the 70-cent method. For the most part, like 99% of my clients, the standard mileage method always works out to be more favorable in their scenarios. The other thing that I would caveat the actual mileage expense method is that if you start that route, if you ever go and expense your mileage or auto expenses via the actual expense method, you're kind of locked into that method for the lifetime of the car. You won't be able to switch back to the standard mileage method. So that is an important factor there, right? And so if you use your car heavily this year for work, you may think, hey, it's better to switch to the actual expense method this year. But then next year, you're going to be locked to that method. So I typically say, hey, just always stay on the standard mileage rate. That's a lot better. A lot less documentation you need to provide. The only thing that you need to do is, keep a log of your travel. So like say, hey, today I traveled 20 miles to see Joe Smith. After that, I traveled another 10 miles to see Jane Smith. So that's kind of how it goes. Like, you just have to have that travel log to back up your mileage. And besides the manual logs, there's tracking apps. MyLikeQ and Everlance are good ones. And if you have QuickBooks has that built in where you have the QuickBooks mobile app, and you could just start a trip there, and it'll keep track of your mileage and all that. And again, from a tax perspective, your tax professional is just going to ask you for the total miles. They're not going to ask you for the evidence, but that burden of maintaining the evidence and records does belong to you as a business owner. Any question on mileage or any of the other topics that we've talked about so far? All right. So let's move on then. The next key area that I want to, we have another question. Do we need to document the mileage using addresses? Because of HIPAA, I can't do that. So you do need to have the evidence of the trip. You don't need to per se have the mileage, the addresses. I would advise you to at least put down the city and state, and just for your purposes. But the key thing that the IRS wants is just like a log showing that the date and the amount of miles and the purpose. Yeah, it is. I'm not an expert on HIPAA, but obviously, like, if you're using a program like Mileage IQ or QuickBooks to track, like, you don't want to put in, patient information in those systems. But if you're using a log journal or something like that, you may have a little bit more leeway, since that just belongs to you. I don't believe the QuickBooks app actually even tracks the addresses or anything like that. It just tracks the miles, and that's the key item that you need. Just like, hey, on this day I started a trip for this miles. The business purpose was patient visit. Any other questions or yeah. 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 All regulations are scary. So definitely want to make sure that we're in compliance with them. Um, so one of the key things to note too is like a lot of these softwares, they have like regulated modes. Like you can see if they are certified for HIPAA and stuff like that. And I would definitely advise to look at that. Like for example, like Google Cloud, if you're using it for emailing patients and stuff like that, they do have like a HIPAA certification. So I don't know if like MileIQ or any of them have it, but that is something to consider. All right. Eric says, definitely have some questions as to resources regarding employee cost calculators you trust. Sure. Eric, if you want to type your questions in the chat, I'll be glad to go through them. Or we can, or if you want, we can save it for the Q&A at the end. Oh, sorry, missed this one. If you have employees and you reimburse them for mileage, is that reimbursement deductible? Great question. And that is actually one of the topics that we will be talking about. But I will jump to that because I think it actually makes sense here. Well, all employee reimbursements, right? Like mileage costs, equipment purchases, travel expenses. The key item is that you need to differentiate that as a business expense versus a fringe benefit, right? A fringe benefit is something that really is like a perk of working here, like versus a necessity of working here. It's hard to kind of explain for the most part that that reimbursements should have is more so reimbursements are sort of like things that the employee incurs to work for you versus fringe benefits are like a perk offered by you to get the employee to work for you. So let's say like a home office stipend. Let's say, hey, you're gonna give your employees a home office stipend of like $1,000 to set up their home office. If you're a remote company and you don't have a physical office, then that is considered something that could be reimbursable because that's a necessity to work for you. But if you have a physical office, then it's more so a fringe benefit because it's not a necessity. It's just an additional perk that you're giving the employee. Other things like, you know, gym memberships, things like that are pure fringe benefits, right? And what that means is that even though you reimburse the employee for this stuff, you have to mark it in your employee's W-2 as something paid to them, and they're going to end up paying tax on it. So that's the key differentiator there. Like it's something that you reimburse or pay, but it's taxable to the employee as income. Whereas it's a true reimbursement like mileage costs, equipment purchases, travel expenses, those are expensed by you as a business and when it's reimbursed to the employee. And the key thing for that as a small business owner is that you need to have an accountable plan that says how you're going to reimburse, right? So this is basically like a document saying, hey, I'm going to reimburse these types of expenses. The expenses must be job related. You have to have a process for submitting the receipts and collecting, you know, any excess payments, right? So as long as you have it documented that, hey, these are the ones that are being expensed and have a process for that, then you could go and reimburse the employee subject to, versus it being a fringe benefit or an actual reimbursement. Things like the mileage expense, you're definitely able to expense, reimburse back to the employee. But again, like it's based on, for mileage, it's based on, the IRS mileage rate, like the 70 cents. So if your employee drives 100 miles, you can reimburse them $70 at that 77 rate. If you reimburse them $75, that extra $5 is a fringe benefit. So that is something to keep in mind, and you will need records and all of that for. So again, the key thing here is to have like a process defined, and then have a process to capture the receipts and evidence, right? When you're doing it for yourself, you have all the evidence, but when the employee is traveling on your behalf, you need to make sure the employee submits that evidence to you. And it could be just like a Google sheet that you have the employee fill out and say, hey, write down how many miles you drove for today and what the purpose was. But you need to make sure that evidence is there. Any questions on this? Did that answer your question, Tommy? All right. I am going to move on to depreciation and interest, right? So this is another. We talked about this a little bit earlier about depreciation. This is a common thing that people forget. Large purchases should be depreciated over time versus immediately expensed. And the reason for that is that like I said, the IRS says like, hey, you bought a huge expense this year just to reduce your income, and that's not going to work. We're going to every year, then you could just buy something big and basically have no income tax, right? So they implemented depreciation basically to get like the useful life out of your item and deduct the expense over that useful life. So the way that it works is that they have what's called classes for different asset types. So let's say you purchased your own office building, right? So that is a building, and that has like a depreciable life of close to 30 years. So if you paid $300,000 to purchase that office building, you only being able to deduct, well, with that, it's a little bit nuance too, because you can't deduct the land value. But let's say, just for this purpose, let's just say flat 300,000, you'll only be able to deduct 10,000 a year for 30 years. If you purchased a car, usually that as like a 5 or 7 year depreciation life. So you have to depreciate the total value over 5 or 7 years. The other key thing to look out for here is that if you sell something that you've depreciated, basically it can result in a huge tax bill, because even though, let's say you bought the car for just making up numbers, you bought a car for $5,000, and 5 years later you sell it for $2,000. So you may think that, hey, I bought it for 5, I sold it for 2, so I'm in a net loss of 3, so I'm not paying any taxes on it. But because you depreciated over the 5 years, that at year 5, that has like a zero value. So then you're paying taxes on $2,000, $2,000, right? Because you claimed $5,000 in expense, that car is depreciated, yet you sold it for $2,000. So now there is net income there in the eyes of the IRS. I've had a lot of clients get into sticky situations with depreciation, so it is just something to be careful of. in your tax returns, there should be a depreciation schedule which tracks your big purchases and the amount that's depreciated, the amount that's remaining, and all that. So that is something to be cognizant of. Um, the one thing, a couple of other items to note, right? I've also had clients that um, have like something that they purchased and they forgot to depreciate, and um, sometimes they don't go back and fix that. But it really depends, right? The IRS, in the IRS's view, it should have been depreciated starting the first year. So even if, like, let's say like you never depreciated your car and you sold it for the $2,000 or $2,000, and you're going to say, hey, I never claimed that $5,000 worth of depreciation, so this is not net $2,000 for me. The IRS is going to say, too bad, that's not our fault. You should have claimed it. And then the only way to fix that is to go back and amend your taxes. But there's statute of limitations there. You can't amend past 3 years, so that you're kind of SOL at that point. So um, with a car, it's the 5 years is not too much, but like I've had it happen to clients that have like rental properties and stuff like that, where they never took out the depreciation when they sold the property. They had a huge tax bill. So just really something to be cognizant of. There are some new perks with like the tax changes that happened recently. There are what's called bonus depreciation. So for certain things, the IRS is going to give you like a bonus depreciation. They said, all right, you can just depreciate the whole thing the first year. We don't care. You still have to track it and over the useful life, but you can just claim the full amount the first year. Same thing with Section 179. That used to be 100% write-off. I think it's down to like 80% now, but things that were Section 179 and the Congress, makes these lists of what things qualify and what not, probably based on who pays them the most, right? But if you had items that were on the Section 179 list, you could have claimed them off the first year. This was the popular one with like the vehicles over 7,500 pounds. So everyone bought these, G classes and wrote them off. But that's that Section 179. The other thing I want to talk about here is deductible interest. So even let's say, like going back to that car example, right? Let's say that you finance the car instead of purchasing it, right? So let's say you now have a $500 a month car payment, and $100 of that is interest, $400 of that is the actual car principal itself. So that $400, that amount should add up, should be included in your depreciation already, and you can't expense that again. You can't expense a monthly $400 expense for your car because you're already expensing the value of the car, right? But you did not expense the interest on the loan of the car. So that's a separate expense. And that's something that you should be expensing as interest expense separately. So the value of the car, that should be tracked in depreciation. The interest on the car loan, that's tracked as a direct expense. Any questions there? I know that's a confusing one. All right. Now just special considerations for S corps. One thing we said, like the reimbursements, you need the accountable plans, and obviously you need all the documentation. Things like major purchases technically should have corporate minutes. I don't think the IRS is ever going to actually come and check for that, but technically you need to operate as like a corporation, right? A lot of the owner benefits are fringe benefits, and you do need to include in the owner's salary. And then the owner also has to have a a reasonable salary to pay themselves. And that is, also expense from the business, the owner's salary. Justin asks, what about a lease? Great question. So a lease is a great way to go about it, because the lease is you're basically renting. So the full lease payment is expensible. You don't get the additional depreciation or anything like that. You don't have to worry about anything like that. You just have the lease payment, and that is an expense. And at the end of the lease, you terminate the lease, and you don't have to worry about getting selling the car or anything like that. So that's why a lot of businesses often lease equipment rather than purchasing. All right, going to the moving on. Just a couple of best practices here. We talked about these before, but it's the key things here is you want to separate your business finances, you want to maintain detailed records, and use software where possible. The other thing that not really related to deductions, but you need to be making your quarterly IRS payments, and that's based off your net income. So you should calculate your your income and expenses at least quarterly, so you can make your actual tax payment. If the car is leased and is being driven 80 to 90% for business, is it possible to have the business own it? So this is a great question. So the key item here is that not really the legal aspect to have the title in the car's name, but oftentimes it's like the insurance companies and the financing. Well, I guess for lease it doesn't matter, but for insurance purposes and stuff like that, having it in a business name usually results in a higher expense. So for the most part, you get the same benefit by just saying it's a business use vehicle, and you claim it personally and do the actual expense method. But that way you don't have to retitle the car or anything like that. If you do retail the car, you just pay all the expenses from the business itself. But the only thing I would say, keep in mind with the actual expense method is that you should consistently have that 80 to 90% use for the life of the car. Otherwise, you kind of screw yourself out of the mileage expense. The business could offer us car allowance to the CEO. Yeah, so this would be most likely considered a fringe benefit, right? Like, do the CEO need a car to do to do the job, right? And it's a great. I mean, you can argue both ways if they do need to travel a lot, but I don't know. I personally would not go that route. That's the one challenging aspect about tax law. A lot of it is like subject to interpretation. The IRS really does not give that much prescriptive guidance. Say, hey, like this purpose is allowed, this purpose is not. They give more general saying majority of the use must be for business and stuff like that. So as long as you could prove it, have the documentation to prove it, then you could justify and say, hey, this is not a fringe benefit. It is an actual requirement of the job. But yeah, I would definitely talk to a tax professional to kind of get some more background on that exact use case. All right. That sums up the presentation for today. Like as always, consult a professional before you have any questions. If you have any questions, and don't do anything crazy or that seems wrong. That typically is going to cause a red flag with the IRS, and they'll come knocking. I have clients that go a little bit crazy with all sorts of documentation, but for the most part, like as long as you the way that the IRS systems work, right? Like everything is automated, right? They have baselines for all types of businesses, and for the most part, like unless you are heavily deviating from the business baseline, they're not going to take a close look at your tax return. They're more concerned about the bigger fish out there. But if you have a big deviation, that's going to automatically set out some sort of alert or flag, and then somebody's going to go in, and then if they seem like they have questions, then that's how get yourself into an audit. So that's where you want to for the what I say is like be sensible, don't go crazy with the expenses. You don't have to go crazy like with documentation and all that, but like don't overcharge over every single meal is a business meal. Stuff like that is just asking for trouble. I have been reading about, okay, we got a few questions here. I've been reading about the PAA for HIPAA compliance with software. Never worked with this before. Can you speak about this high level? So, Michael, I don't know if you may have a better perspective on this from I know business associates need access to HIPAA data, but I don't know how that really applies from a software level.
Yeah, I'm happy to take this one because HIPAA is really important to think about with all your technology, and we know that your practice management, data collection system, clinical system needs to be HIPAA protected and signed to BAA. Now the question is, does your accounting software? And I think the answer is probably no. If you're using your accounting software like normal, you're not putting client information in it. You're putting the dollar amounts that you're getting from insurance, you're putting expenses, but you're not tying those back to individual clients, at least not at any practice that we support. They set up their accounting systems like that? And so because of that, you are not needing to find a HIPAA compliant software system that will sign a BAA with you, because you're just not putting HIPAA protected information into those systems. Yes, Eric. This is it's been a while since we talked. This is definitely a new haircut.
Great. All right. It looks like there's another question from Brianna. I read somewhere that it's best to budget 30% of business income for taxes. No, that's a great methodology. So that's what I typically recommend to my customers too. That hey, every quarter put aside 30% of your taxes. You may necessarily not need to pay 30%. There are things like safe harbor and stuff like that that minimize what you need to actually pay, but up front. But you should put that money aside, because at the end of the year, when you do your actual tax return, you're most likely going to have to pay that, and you want to have that money available, right? There's a lot of variables there too. So like some other folks, like if they have a W-2 or they're paying themselves as an owner for their business, they will just increase their W-2 withholdings so that they don't have to they make those payments automatically. But yeah, generally you want to put aside at least 30%. Is taking an owner's draw versus a paycheck a bad idea? It's not a bad idea, but the thing to keep in mind is that if you are an S corp, you are required to have a paycheck first. So that is a requirement. You need to pay yourself a reasonable salary. The owner's draw is basically a return of investment or a return of earnings. So the careful thing there is that owner's draw reduces your equity in the business. If you have, and for the most part, like unless you guys are depreciating or anything like that, where with big purchases, you should be fine. But where it becomes like challenging is like, let's say that you depreciate a car ahead of time for $100,000, so you have zero net income in the business, but then you take out $100,000 from the business bank account, then it is IRS is like, wait, you had zero income, but then you took out money. How's that possible? Because you kind of like magically wiped your income with depreciation. So then they're saying, no, you're gonna have to pay tax on that owner's draw. So that's when you get in that's a really oddball situation, and I don't think that'll happen. But that's the one thing to keep in mind with owner's draws. It does reduce your equity in the business. That being said, like, every year as you're profitable, your equity increases. So you don't want to keep like so much equity in the business. You want to take that out and use it for personal funds, right? So that is and how you do that is like if you're a sole proprietor, owner's draw. If you are S corp, we would call that as a distribution. Speaking of corporate structures like S corp, here's a question about LLCs. I think on my LLC, I'm listed as member, and I'm the only member. Can we self-assign any title we wish? CEO, president. Yeah. Honestly, like technically, yes. You should have like minutes documenting that. Hey, we've appointed so and so as the members of the LLC have so and so appointed Eric as the CEO and president. Like I don't think anyone's going to actually come asking for those minutes. You can just call yourself the CEO or president. If you deposit personal money into a business, maybe more frequent in the beginning, what are the tax implications? Tommy, that's completely normal. There's no tax implications there. Like in order to start a business, right, you need somebody to invest in it. And typically it's like the business owner putting their own money in, right? So that's recorded as your equity in the business, right? So it's after-tax money you put into the business. Taxes are already paid on it. You can withdraw it. There's no tax implications there. Any other questions before we wrap up?
Awesome. Oh, I think we have one more question.
So if we fund this with our own funds, could we technically consider part of a Roth IRA? I'm trying to understand what you mean by that. Do you mean like you funded it from your Roth IRA, or do you mean something else? Yeah, you mean funding it from your Roth IRA, that, if your Roth IRA allows you to do that, then technically your Roth IRA is the owner of the business. Otherwise, if you took out a loan from your Roth IRA, then you are the owner of the business. So you always would have shares, right? Like if it's an S corp, you would have ownership via shares, right?
Well, I know we're coming up here on time. I want to thank you Ajish, for giving this awesome presentation on Taxes 101 for new practice owners. If you are a BCBA looking to start your own practice, I would love to chat and talk about what you're thinking and how Alpaca can be helpful. So I'm just going to put our website here in the chat. And as we end today's presentation, we'll send out a follow-up email that has the presentation, the deck, and also a link to learn more about working with Alpaca. So thank you all so much for joining. Thank you, Ajish, for presenting. And I hope to see you guys all next time.
Thanks all.
Bye, everyone.